What gold did is exactly what it was supposed to do. So when people with a short-term orientation, the greed buyers of gold, say, I own it at 27 because I think it can go to 3,200. That number becomes real to them looking at the immediate past. That's not why I own gold. I own gold because I have a visceral memory of the decade of the 1970s when the gold price increased in real terms eightfold. I own gold not because I hope it'll go to 3,200, but because I'm afraid it's going to go to 9,000 or 10,000.
In today's news recap, silver price drops to nearly 2-month low, 100-day SMA breakdown in play. Silver attracts some follow-through selling during the Asian session on Thursday and drops to its lowest level since September 19th in the last hour. Bearish traders now await a sustained break below the $30 psychological mark before positioning for an extension of the recent sharp retracement slide from a 12-year peak touched last month. The overnight close below the 50% Fibonacci retracement level of the August-October rally and a subsequent break through the 100-day simple moving average for the first time since September could be seen as a fresh trigger for bearish traders. Moreover, oscillators on the daily chart have been gaining negative traction and are still away from being in the oversold zone. This, in turn, suggests that the path of least resistance for silver price remains to the downside and supports prospects for a further depreciating move. The white metal might then accelerate the fall towards the 61.8% FIBO level around the $29.65 to $29.60 region. The downward trajectory could extend further towards the $29.20 to 25 cents area before eventually breaking below the $29 mark and tests a technically significant 200-day SMA currently pegged near the $28.65 zone. On the flip side, any meaningful recovery attempt might now confront a stiff barrier near the $30.60 region. Some follow-through strength, however, could trigger a short covering rally and allow for silver to reclaim the $31 mark, though the momentum is more likely to remain capped near the 31.20 support turned resistance. The latter should act as a key pivotal point, which, if cleared decisively, will suggest that the commodity has formed a near-term bottom and paved the way for additional gains. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hit the like button, and send a super thanks if you find our daily recaps valuable. Enjoy the episode.
Again, in my experience, history, I've been through, depending on how you count them, either 3 or 4 precious metals bull market cycles, some fairly short, but they followed a predictable pattern. The market was kicked off by a fear buyer buying physical gold. Gold moved first. After the momentum was established in physical gold, some of the better gold producers began to enjoy better profit margins. There's a delayed reaction to this, of course. But when that happened, the biggest gold producers began to move. And that momentum attracted generalist investors. When the generalist investor became interested in the precious metals narrative, a couple things happened. Going right to your question, perhaps because of the lower unit price of silver, leadership in the precious metals market changed from gold to silver. Silver moved later, but when it moved further and faster. Sorry to keep going back to history, but let's look again at the decade of the 1970s. At the beginning of the period, gold was at $35, price controlled. Silver was at $1.20 or $1.25. At the end of the decade, gold was at $850. Silver was at $50. Let's go back then to 2000. At 2000, gold was at $253. And if my memory serves me well, silver was at $5 or $6. At the end of the decade, gold was at $1,700 and silver was back at $50. When market leadership changes from gold to silver, silver runs further and faster, but it takes longer for it to get started. You may remember, or you may not. I looked at my notes of our last interview, yours and mine, or second to last interview at the beginning of 2024. And I had suggested to you that the high quality junior stocks as a whole were really, really, really hated. I love to triumph my past successes on those odd occasions where I was right, and I was really right. And I said, I think that these silver stocks are a coiled spring. Not because I think silver needs to do well over 2024, but rather because everybody who possibly wanted to sell these stocks has already done it. They're hated. And we've seen this weird circumstance in 2024 where the high quality silver juniors are uniformly up 2, 3, 3.5 times, while the silver price hasn't moved much. So I would caution you that it may be that in the next stage of the silver bull market, in the beginning of the market, that silver itself, the metal, might outperform the junior stocks because the high quality juniors have already had such a spectacular run. Looking longer term, again, in my experience, Doug Casey famously points out that the market capitalization of high quality junior silvers is so small. And notice that I say high quality. I'm not talking about the really junky guys. That when the generalist investor becomes interested in the space, there isn't enough room. There isn't enough market cap to contain the money. From the point of view of what silver bullion does, which is to say sells silver, you won't need me to tell you when leadership has transitioned from gold to silver. My experience is that when silver runs, you don't need a crystal ball to understand it's running. It really, really, really runs. Is that going to happen in 2025 or 2026? I don't know. What I do know is that when it runs, whether you had to wait 2 years or 3 years, doesn't matter much. You don't have to trust me on this. Just get a silver price chart going back to 1970 and take a look at what happens to the metal when it runs. It is truly, truly, truly astonishing. I have, I think, about 2.5% of my portfolio in silver stocks right now. And I wouldn't be surprised if organically, without any additions from me, it becomes 20% of my portfolio. They're fairly well chosen silver stocks, but the upside in silver stocks in a silver bull market, the upside in silver itself is just breathtaking. Your audience, most of whom is younger than I, don't seem to think in 5-year timeframes. They seem to have expectations that are limited to the next long weekend. That's a mistake. I wish I would get quicker gratification too, but it doesn't matter much what you wish for. You have to pay attention to what's on offer. And what's on offer is the probability that we are in a precious metals bull market, led by the deterioration of the purchasing power of the US dollar. If that's true, history suggests that after the narrative has been proven with increasing gold prices and the generalist investor comes down into the space, that leadership in the market changes to silver. For me, because I've never understood how to ascertain what real supply is. Traditional holders of silver include, as an example, large parts of the peasantry of India, Bangladesh, Pakistan, and Sri Lanka. They own it because they don't trust their government, which means they're not really good about reporting how much they own. So it's difficult to ascertain what really constitutes supply. I don't know how to do it. It's difficult, too, to understand forward-looking supply because new mine supply is only 17 or 18% of new supply in silver. The rest comes from silver production as a byproduct of mining other metals or from recycling. It's very difficult to generate a supply-demand balance if you don't know what the supply is, either new mine supply or above-ground supply. So after that long-winded answer, I'm going to duck the question. I don't know. Unlike most other commentators, I know I don't know, and I know they don't know. I look historically at the fact that what has really goosed silver periodically has been investment demand. And investment demand is always a function.
On the technical analysis side, silver price shows negative trades to move away and support the chances of continuing the expected bearish trend on the intraday basis. And the way is open to achieve the next target at $30.63, which represents 50% Fibonacci correction level for the rise from $26.41 to $34.85. Thus, breaking it will push the price to suffer additional losses that reach $29.64. Holding below $31.63 represents the first protection factor to the suggested negative scenario, as breaching it will lead the price to achieve intraday gains and test $32.86 before any new attempt to decline. Let's get back into the episode.
Most people describe themselves as conservative investors, when in fact they're wild speculators. It's okay to be a speculator, but you need to acknowledge that yourself that you are a speculator, and you need to prepare yourself financially and psychologically for speculation. All the money I now invest conservatively, I made speculating aggressively. So that's the first thing. The second thing is that most people own way too many stocks. Way too many stocks. I ask investors, or speculators rather, to own the number of stocks that corresponds with the number of hours per month that they're prepared to spend studying the stocks. If you're prepared to spend 10 hours, then you should own 10 stocks. But many, many, many people whose portfolios I've graded own 60 or 70 stocks. And I know that they're not spending 60 or 70 hours. The third thing that I would suggest is that most investors have very long-term perspectives and narratives, but they have short-term tactics. If you own silver stocks because you think silver is going to go up over 5 years, you need to be prepared to hold them for 5 years. But the idea that you own commodity stocks based on a commodity narrative, and you don't allow the investment time to give you compounding, means that you set up to fail. There's a contradiction between your strategy and your tactic. And that contradiction between strategy and tactics, I think, is the principal reason why most speculators are losers. Fidelity did a study where they took tens of millions of investors in Fidelity products worldwide, and they segregated those investors into various subgroups: men, women, rich men, Caucasian, black, Hispanic, blah, 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 all this kind of stuff, right? And they tried to find which investment subgroup did the best, had the best outcome. And dead people. People who didn't trade, who didn't fall for the latest hyperbole. It was dead people that outperformed every other subgroup at Fidelity. I'm not suggesting death as an investment strategy. I'm just suggesting that not chasing the latest fad is how one does well. And let's look at history and arithmetic. In the decade of the 1970s, with the US dollar losing 75% of its purchasing power, the gold price went from $35 to $850, a 30-fold increase. Let's strip part of that out, just for fun. Let's say that the move from $35 to $100 was due to the legalization of gold ownership, because gold had been price controlled for 40 years? So let's say at the beginning of the decade, just for fun, that gold was $100 an ounce. At the end of the decade, with a 75% deterioration in the purchasing power of the US dollar, gold was at $850, an 8.5 fold gain. Then let's fast forward to the decade 2000 to 2010, the last time the US dollar was under internal assault. At the beginning of that decade, the gold price was $253. At the end of the decade, the gold price was $1,700, a seven-fold increase. Or, just for fun, let's lengthen the time frame. Let's do 2000 until today. At the beginning of the millennium, gold was at $253 an ounce. Now it's $2,700. What's that, an eightfold increase, ninefold increase? Gold has done exactly what it was supposed to do for the last 24 years. It has maintained its purchasing power. If I'm right, and the decline in the purchasing power of the US dollar is at 7.5%, it was less earlier, and gold increased in value by 8% compounded over 24 years, what gold did is exactly what it was supposed to do. So when people with a short-term orientation, the greed buyers of gold, say, I own it at 27 because I think it can go to 3,200. That number becomes real to them looking at the immediate past. That's not why I own gold. I own gold because I have a visceral memory of the decade of the 1970s when the gold price increased in real terms eightfold. I own gold not because I hope it'll go to 3,200, but because I'm afraid it's going to go to 9,000 or 10,000. Patrick, I would dearly love to be wrong. Metals and precious metals related investments in the United States market is about 0.5%. After a pretty good rise in the gold price, the 4-decade mean market share was 2%. Gold doesn't have to win the war against the US dollar. We don't have to have a cratering of the treasury market. All we have to do is revert to 4-decade means, and demand for precious metals and precious metals related investments grows fourfold. Imagine what a fourfold increase in demand would do to price. Or, if you don't want to look forward like that, look backwards. Look at the decade of the 1970s, or look at the decade 2000 to 2010. Don't overinvest in gold either, because what you learn is that if you regard gold as insurance, a fairly small investment yields pretty good coverage. If, as an example, at the beginning of the decade of the 1970s, you had 10% of your portfolio in gold and 90% in other assets, but let's say just for fun that you had them in the long bond market and the stock market, 60-40 or 40-60. At the end of the decade, you would have lost 35 or 40% of 90%. But in gold, you would have made 8 times your money, which is to say you would have come out of that decade with only a 10% allocation to gold, with your purchasing power, with your wealth maintained. And I think people who ignore history like that are probably going to experience a fairly unpleasant 10 years.
And there you have it. Jim Rickards is calling for silver to hit $100 and gold to reach an incredible $10,000. What do you think? Could we really see these kinds of prices? Drop your thoughts in the comments below and let's get the conversation going. Don't forget to like and subscribe if you want more updates on what's next for precious metals and the economy. Thanks for watching. Now check this video right here because it's a perfect fit for you. I'll see you on the other side.